Okay, let's dive right in. Think about this scenario. It's 8:30 a.m. Eastern Time, first Friday of the month.
Yep, the big one.
Exactly. All around the world, you've got traders glued to their screens, algorithms just, kicking into high gear.
The whole financial world holds its breath.
It really does. And then, bam, this single report drops. And instantly, the US dollar is either soaring or tanking.
Mm-hmm. Treasury yields are all over the place.
Yeah, whipsawing. And stock futures, they're doing their own crazy dance. This isn't just like some random data.
No, not at all.
It's seen as, well, pretty much the backbone of the U.S. economy. And it consistently, historically, rocks global markets. Just a few number.
It's incredibly influential.
So much so that even if you see other signs, strong economic growth maybe popping up elsewhere, markets often look at those signs with, well, a bit of suspicion if this report doesn't look healthy, too.
That's right. It needs confirmation from the jobs data.
So if you really want to get what drives the biggest market moves, especially for the U.S. dollar, you absolutely have to understand this report.
Couldn't agree more.
So what is this powerhouse report? It's the non-farm payrolls, NFP for short.
NFP, yep.
It comes out every month from the U.S. Bureau of Labor Statistics, the BLS. And its main purpose is to give us the freshest look at the U.S. economy's health, specifically through the lens of the job market.
It's all about jobs.
At its heart, it measures the number of paid workers in the U.S., specifically in non-farm businesses.
Right, the non-farm part is key.
Yeah, so why non-farm? Well, it excludes farm workers, mainly because that kind of work is so seasonal.
Yeah, it would skew the numbers month to month, make it hard to see the real trend.
Exactly. It also leaves out self-employed people, unless they're incorporated and pay themselves a salary.
And volunteers, household workers.
Right, private household workers and active military personnel, too. But even with those exclusions, it's still capturing, about 80% of the workers who contribute to GDP?
Yeah, a huge majority. It's a really broad snapshot, despite the name.
So our mission today in this deep dive, we want to go beyond just knowing the name NFP. We want to really unpack it.
Get under the hood.
Exactly. Figure out why this job market snapshot causes such massive immediate market reactions. We'll look at how people try to predict it beforehand.
The leading indicators, yeah.
Understand all the different bits inside the report, not just the main number, because that's often where the real story is.
The details matter a lot.
And then look at what actually happens in the moments after the release, how the market digests it all. We're basing this all on the sources we've gathered.
Okay, sounds good. And you really nailed why it's so central. It's that direct link to the economy and maybe even more importantly to monetary policy.
Ah, right. Let's start with the economy link first.
Okay, so think basic economics. Jobs mean income.
Right. More people working, more money in pockets.
Exactly. And hopefully wages are going up too. That means more disposable income for households. And what do people do with income?
They spend it. Mostly.
They spend it. And consumer spending is like the engine of the U.S. economy. It drives about 70% of GDP.
Wow, 70%. That's huge.
It is. So a strong jobs report isn't just a number on a page. It means more economic activity is likely happening or about to happen. More people earning, spending. It fuels growth.
Okay, so it's not abstract. It's real people, real spending power. But you mentioned monetary policy. That feels like the real reason financial markets freak out so much. It's the Fed, isn't it?
That is absolutely the crux of it. This is the connection that has traders on edge every first Friday. The Federal Reserve, the Fed, has what's called a dual mandate from Congress.
Maximize employment and keep prices stable.
You got it. Maximize employment and maintain stable prices, which basically means keeping inflation low and predictable. So the Fed watches the labor market very, very closely.
Not just for jobs, but for inflation signals.
Precisely. If the job market gets really strong, unemployment is low, hiring is robust.
Yeah.
Crucially, wages are climbing fast. They can signal trouble ahead.
Inflationary pressure.
Exactly. Businesses have to pay more for workers and those higher costs. They often get passed along to us, the consumers, as higher prices. That's inflation building up.
And the Fed hates runaway inflation. Their main weapon is interest rates.
That's their primary tool. So if the NFP report looks really hot, showing a tight labor market and strong wage growth, the Fed might think, uh-oh, inflation could pick up steam.
So they raise rates to slow things down.
Right. They raise their benchmark interest rate.
Yeah.
That makes borrowing more expensive for businesses planning to expand, for people wanting mortgages or car loans. It dampens spending and investment, which helps cool off the economy and curb inflation.
And the opposite is also true. If the NFP is weak.
Yep. If the report shows fewer jobs than expected, maybe unemployment ticking up, wages flat, that suggests the economy might be slowing, maybe even heading for a downturn.
So the Fed might cut rates.
They might lower interest rates, make borrowing cheaper to encourage businesses to hire, encourage consumers to spend, basically give the economy a boost.
And interest rates. Well, they're the bedrock for practically all financial markets.
Absolutely fundamental. Think about it. Higher U.S. interest rates make U.S. assets, like Treasury bonds, look more attractive to global investors hunting for better returns.
So money flows into the U.S. dollar.
Exactly. Demand for the dollar goes up, it strengthens against other currencies. That's why you see big moves in pairs like euro-dollar, pound-dollar, dollar-yen. The NFP shifts expectations about future interest rates and thus the future value of the dollar.
And bonds, stocks.
For bonds, higher rates mean existing bonds with lower yield become less valuable, so their prices fall. But new bonds issued at higher rates become more appealing.
So money might move from other things into bonds.
Potentially, yeah. And for stocks, higher rates are usually bad news. It costs companies more to borrow, which can hurt profits. Plus, in finance, they use something called a discount rate to value future earnings. Higher interest rates mean a higher discount rate.
Which makes future profits worth less today.
Precisely. So stock valuations can take a hit. This whole chain reaction, NFP data, Fed rate expectations, currency values, bond yields, stock prices, that's why this one report wields so much market power. It's all about anticipating the Fed.
Okay, that makes perfect sense. It's all about predicting the Fed. So, naturally, you can't just wait until 8:30 on Friday morning. People must be trying to figure this out beforehand.
Oh, absolutely. The pros don't operate in a vacuum.
This is where the leading indicators come in, right? Trying to anticipate the NFP.
That's exactly it. Traders, analysts, economists, they spend the weeks leading up to the NFP release tracking a whole bunch of other economic data points.
Looking for clues.
Looking for clues, trying to piece together a picture of the labor market before the official BLS numbers drop. They're trying to form an educated guess. This helps shape what's called the consensus forecast.
Ah, the consensus. That's the number everyone compares the actual NFP to, right? The average expectation.
Exactly. It's the benchmark. So let's talk about some of those key leading indicators mentioned in the sources. First one, challenger job cuts.
Okay, challenger job cuts. What's that telling us?
This report, from a firm called Challenger, Gray & Christmas, tracks layoff announcements by companies, planned cuts.
Ah, so it's forward-looking. Not what happened, but what companies plan to do.
That's the key insight from the sources, yeah. It's about future intentions. It aggregates announced layoffs and also announced hirings, though layoffs get more attention. It's not the whole picture, but it's an early warning signal.
So if you see a sudden big jump in announced layoffs, that's a bad sign for the upcoming NFP.
Generally, yes. A large, unexpected spike in challenger cuts suggests companies are planning to shrink their workforce, which would likely mean weaker job growth in the near future. It's a potential negative signal for NFP.
How do analysts actually use it? Do they just look at the number?
Well, the sources suggest one interesting way is to use the historical average. Say your model predicts 300,000 jobs for NFP. But the recent Challenger reports show an average of, say, 50,000 announced cuts.
You might knock your estimate down.
You might discount it, yeah.
Yeah.
Maybe revise down to 250,000, acknowledging those planned layoffs are a headwind. It's a way to factor in future softness. It usually comes out early in the month after the previous month ends. FX Street is a good place to track it.
Got it. And the sources mentioned something about checking the source.
Oh yeah, crucial point. They gave an example where a huge Ford job cut number, like 20,000, was widely reported.
But it was wrong.
It was wrong. The actual number was much smaller, like 1,400, and Ford had already corrected it. But the wrong number spread first. It just highlights, double check if you can. Accuracy matters when building that pre-NFP picture.
Good reminder. Okay, what about jobless claims? Initial and continuing claims. Those sound pretty direct.
They are very direct. Initial jobless claims.
Oh.
How many people filed for unemployment benefits for the first time that week?
Okay.
Continuing claims. How many people are still receiving benefits after filing initially? These come out weekly, so they're timely.
And how do you read them? Higher numbers are bad.
Generally, yes. A sustained rise in initial claims means more layoffs are happening. That's negative for NFP prospects. A rise in continuing claims suggests people are staying unemployed longer, struggling to find work. Also negative.
And falling claims are good.
Right. Falling claims suggest fewer layoffs and people finding jobs faster. Because the weekly numbers can jump around, analysts often use a 4-week moving average.
To smooth it out.
Yeah, to see the underlying trend more clearly. Sometimes, the sources note, initial and continuing claims can actually move in different directions for a bit.
Oh, that complicates things.
It does, adds another layer to the puzzle. But you can track both easily on places like FX Street.
Okay, moving on. Business surveys, the ISM ones. Manufacturing and non-manufacturing PMI employment components.
Right, from the Institute for Supply Management, ISM. They survey purchasing managers in manufacturing and services sectors.
And ask about employment.
Yep. Part of the survey asks if employment levels in their company are going up, down, or staying the same. A reading over 50 generally means expansion. Below 50 means contraction in employment for that sector.
And which one matters more, manufacturing or services?
Historically, some focused more on manufacturing, maybe thinking it was easier to measure. But the sources stress the non-manufacturing, the services sector, is way more important now.
Why is that?
Because services make up something like 70% of all U.S. jobs. Manufacturing is still relevant, but the services employment reading gives you a much, much broader signal about hiring across most of the economy.
Makes sense. When did those come out?
Usually the first business day after the month ends, so quite early.
Okay. Then there are consumer confidence surveys. University of Michigan.
Yep, the University of Michigan Consumer Confidence Index. They ask consumers how they feel about the economy, their own finances, job prospects.
And this is considered a leading indicator for NFP.
It is. And one reason, according to the sources, is its timeliness. Some data is gathered very close to the release date, so it's a fresh read on sentiment.
So high confidence means people feel good about jobs, potentially points to a strong NFP.
That's the basic idea. High confidence could signal a strong NFP. But, and this is a key nuance from the sources, it's more reliable if other labor indicators are pointing the same way. Don't rely on it alone.
Okay.
And there's a fascinating behavioral insight mentioned. This survey seems better at picking up the first signs of an economy weakening or getting tired, rather than signaling the start of a strong recovery.
Why would that be?
Maybe loss aversion. People react more strongly to potential bad news, like job insecurity starting to creep in, than they do to gradual good news. It's an interesting angle.
It is. When does Michigan release?
There's a preliminary number mid-month and a final number at the end of the month. You can find history on FX Street.
And there's another one, the Conference Board Consumer Confidence Index, similar thing.
Similar, yes. Also surveys consumers. The sources mention its questionnaire focuses a bit more directly on how people feel about labor market conditions.
So, again, rising confidence good for NFP, falling confidence bad.
That's the expected correlation. But there's a caveat. The Conference Board surveys a new group of people each month. Michigan has some repeat participants.
Does that make a difference?
It can make the Conference Board number a bit more volatile month to month. So analysts tend to look more for the trend over several months rather than just one reading. The actual data might require a subscription, but news about it is widely available. FX Street Search works.
Okay, got it. And saving maybe the most watched one for last, the ADP employment report.
Ah, yes. ADP. Everyone watches ADP.
Why is it such a big deal?
Well, ADP is a huge payroll processing company. They release their own monthly estimate of private sector job growth based on their actual anonymized payroll data from millions of workers.
So it's based on real payrolls, not a survey.
Exactly. And because it comes out a couple of days before the official BLS NFP report, which includes government jobs too, the market sees it as a potential harbinger, an early clue.
Is it accurate? Does it predict the NFP well?
This is critical. The sources show a chart with historical correlation, yes. Over the long run, they tend to move together. However,
There's always a however.
always, the sources strongly emphasize that in any single month, the difference between the ADP number and the official NFP number can be huge, really substantial and unpredictable. They don't always match up closely month to month.
So why watch it so closely then if it can be way off?
Because it's still timely data from a massive sample size. And just like the NFP, if ADP shows consistently strong private job growth, it feeds into those same concerns about potential inflation and the likelihood of Fed rate hikes. So even with the potential for a big miss versus NFP, a surprisingly strong or weak ADP number definitely shapes expectations going into the official release.
Okay, so we've got challenger cuts, jobless claims, ISM surveys, consumer confidence from Michigan and the Conference Board, and the ADP report. That's a lot to track. How do people put it all together before the NFP release?
It's about synthesis and looking for patterns. The sources suggest a few steps. First, look for unanimity. Are most of these indicators pointing in the same direction, strong or weak?
If they all agree, you have more confidence.
Exactly. More confidence in the likely direction of the NFP. Second, compare the overall signal you're getting from these indicators to the market's consensus NFP forecast.
See if your reading matches the crowd.
Right. If your analysis of the leading indicators suggests the NFP might come in way higher or way lower than the consensus, that's where the potential for a big market surprise lies. That's where the volatility could really spike.
And if the indicators mostly line up with consensus,
Then the actual NFP might just confirm what the market already expects, potentially leading to a less dramatic reaction. And third, you try to assess if the market price, say, the dollar's value already reflects the expected outcome.
the buy the rumor, sell the news idea.
Precisely. If the dollar has already rallied strongly before the NFP release, because everyone expects a strong number, the actual release of that strong number might trigger selling, as the news is already priced in. Spotting these patterns, unanimity, divergence from consensus, pricing helps traders prepare even if they wait for the actual number before acting.
Right, preparation is key. Okay, so the prep work is done, expectations are set. It's Friday, 8:30 a.m. Eastern, ding, 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 numbers hit. That immediate reaction, it's all about the headline NFP number versus the consensus, right?
Absolutely. That initial split-second reaction, driven almost entirely by the deviation of the actual headline NFP number
Yeah,
from that consensus forecast.
the difference between what was expected and what we got.
Exactly. Places like FX Street even calculate and show that deviation because it's so important. The sources mention that a deviation of, say, 3 standard deviations or more from the consensus is almost guaranteed to cause a major market move.
So headline beat versus expectation, dollar up, yields up, maybe stocks down initially.
That's the classic knee-jerk reaction, yeah. Assuming the market takes the strong number at face value, initially good for the economy, therefore increasing chances of Fed hikes. But, and this is so important, you cannot stop there.
Because the report has more layers.
So many more layers.
Right.
And those other components can totally change the story and the market's direction.
Like the revisions to previous month's numbers, people often miss those.
They do, but they could be incredibly impactful. This is a really key insight. The BLS always revises the NFP numbers for the prior 2 months as more data comes in.
And the revisions can be big.
Very big sometimes. One source mentioned potentially up to 30% for a single month. Think about that. If this month's headline is kind of meh, close to consensus, but they revised last month's numbers significantly upward.
It means the job market was actually stronger than we thought. There was more momentum.
Exactly. That revision provides new information about the underlying trend. It can absolutely move markets, especially if the headline wasn't a shocker. Analysts even look at the 2-month net revision, adding up the changes for both prior months.
So upward revisions reinforce strength, downward revisions signal weakness.
Right. Brian Tooney and the sources talked about how these revisions affect calculating averages over time, which he uses for trend analysis. So yeah, headline gets the flash, but revisions provide crucial context.
Okay, beyond the payroll count and revisions, there's the other survey, the household survey. That gives us the unemployment rate.
Correct. Different survey, different data points. The number you hear most often is the U3 unemployment rate.
What does that measure again?
People who are unemployed, available for work, and actively looked for a job in the past 4 weeks.
Actively looked is key.
Very key. But the BLS also publishes the U6 rate, often called the underemployment rate.
What does that include?
It includes everyone in the U3 rate, plus discouraged workers, people who want a job but gave up looking because they think none are available.
Okay.
And it also includes people working part-time who really want full-time work but can't find it. So U6 is a much broader measure of labor market slack.
And the way the household survey defines employed, there's some quirks there, right? The sources seem to emphasize this.
Absolutely. This is a really critical point for interpreting that U3 rate. In the household survey, you are counted as employed if you work just 1 hour for pay or profit during the survey week.
Just 1 hour.
Just 1 hour. Also, if someone has, say, 3 part-time jobs, they're counted as only 1 employed person in this survey.
Whereas the payroll survey might count those as 3 jobs.
Potentially, yes, if they're on 3 different payrolls. This definitional difference means the headline U3 unemployment rate can sometimes fall for reasons that aren't purely positive.
Like people taking very minimal part-time work or giving up looking.
Exactly. If the U3 rate drops, but the U6 rate stays high or rises, or if lots of people are just taking a few hours here and there, it's not necessarily a sign of a booming job market. It tells you something about the quality of jobs too.
Which brings us to the labor force participation rate.
Yes, another vital piece from the household survey. This measures the share of the working age population that is either employed or actively looking for work. Basically, how many people are in the game.
And a falling participation rate is bad.
Generally, yes. It means a smaller slice of the potential workforce is engaged. A really strong signal is when the unemployment rate falls and the participation rate holds steady or, even better, rises.
What if unemployment falls but participation also falls?
That's a weaker signal. It suggests the drop in unemployment might be partly due to people dropping out of the labor force altogether. They're not counted as unemployed anymore because they stopped looking. This often happens with discouraged workers in a tough economy. Fewer people in the workforce isn't great long term.
Okay, now wages. Average hourly earnings. You mentioned earlier this is getting a lot more attention.
Hugely important, especially now. The sources really highlight this shift. For a long time, the headline NFP number was king. Now, average hourly earnings, the month-over-month and year-over-year changes are arguably just as important, maybe more so when unemployment is already low.
Why the increased focus?
It connects directly back to the Fed and inflation. Rising wages mean more income for consumers, yes. But for the Fed, strong wage growth is a major warning sign for future inflation.
Because higher labor costs get passed on as higher prices.
That's the fear. If wages are accelerating rapidly, the Fed sees that as significant inflationary pressure building, making them more likely to hike interest rates. This wage number can completely change the market's reaction to the headline NFP.
So a strong job number could be offset by weak wages.
Absolutely. One source specifically mentioned a time when a strong headline was clearly offset by poor wages. The market might initially rally on the job number, then sell off when it sees wage growth disappointed, because that reduces the immediate pressure on the Fed to hike rates.
And the opposite. A weaker job number, but surprisingly strong wages.
Could actually be seen somewhat positively by the market, or at least cushion the blow, because strong wages keep the inflation Fed hike narrative alive. It really colors the whole report now.
Okay. And the last piece, average weekly hours.
Right. Average weekly hours worked, including overtime. This gives hints about how hard businesses are working their current staff.
How so?
If average hours are consistently rising, it might mean demand is strong, and companies might soon need to hire more people to keep up.
Or maybe they can't find people.
That too, especially later in an expansion. If hours stay high or keep rising when unemployment is low, it could suggest companies are struggling to find qualified workers and are just making their existing employees work longer hours. So it provides clues about future hiring needs or labor tightness.
Wow. Okay, so headline NFP, revisions, U3 unemployment, U6 underemployment, participation rate, average hourly earnings, average weekly hours. It's a lot hitting the screen at 8:30 a.m. No wonder the initial reaction can be messy.
It's incredibly messy sometimes. That immediate knee-jerk reaction is almost always just algorithms and quick traders reacting purely to the headline NFP versus consensus. That's the first data point they process.
But then the rest of the data sinks in.
Exactly. Over the next seconds and minutes, the algorithms and human traders digest the revisions, the unemployment details, U3 versus U6, participation, hours, and especially those average hourly earnings.
And the market can change direction.
They're very often. You frequently see that whipsaw reversal. The dollar might spike up on a headline beat, but if the wage number disappoints or revisions are negative, it can snap right back down or vice versa. Then maybe a more sustained trend emerges as the market figures out the overall message.
James Chen's example you mentioned earlier illustrated that.
Yeah, his description of the dollar spiking, reversing, then surging again really captures how the market processes these different layers of information in real time. Gold often does the opposite dance.
And this is where we see that good news for the economy is bad news for the stock market dynamic play out.
Right. The sources really drive this point home. A super strong NFP report, lots of jobs, low unemployment, maybe hot wages is objectively good for the real economy. People have jobs, they're spending.
But the stock market often falls.
Often falls. Because that same strong report makes the market think, okay, the Fed is definitely going to raise interest rates now or keep them higher for longer to fight potential inflation.
And higher rates hurt stocks.
Right. Higher borrowing costs for companies. And that higher discount rate we talk about makes future earnings less valuable today. So bonds might look relatively better. Money can shift out of stocks into bonds. It highlights that slight disconnect. Sometimes the Fed focuses on the whole economy. Wall Street focuses more immediately on asset prices. As one source put it, they're related but different things.
And some markets feel this more acutely than others.
Definitely. Currencies, especially anything against the US dollar like EURUSD or GBP/USD, are right in the firing line.
Hmm.
The dollar index moves sharply. US Treasury yields react instantly to shifting rate expectations, usually up on a strong report, down on a weak one.
That July 2017 example you mentioned earlier showed the complexity. Strong headline, but
Exactly. Headline beat expectations. Revisions were positive too, looked great initially, but wages missed estimates, and unemployment and participation ticked up slightly. So the market reaction after the initial jump was more muted. The weak wages offset the strong job number, reducing the urgency for big Fed hikes. It proves you have to look at all the pieces.
And what about that historical 50,000 range observation from Brian Toomey?
Oh yeah, that was an interesting point he made. He observed that historically, the month-to-month change in NFP often stays within about 50,000 jobs of the previous month's revised number.
So moves bigger than that are unusual.
According to his analysis, yes. And he suggested that when the NFP number does break outside that plus-minus 50,000 range compared to the prior month, it tends to correlate with bigger, more sustained moves in currency pairs, like the euro-dollar. It's a specific historical pattern some traders might watch for potential trade signals.
Interesting. But just trying to trade this right at 8:30 a.m. sounds treacherous.
It really is. The sources acknowledge this practical reality. In those first few seconds or minutes, the volatility is so extreme and the volume so high that markets can become very thin, very illiquid.
Meaning it's hard to get your trade filled?
Hard to get filled at the price you see on the screen. Prices can jump around wildly, what's called flashing. Spreads widen. Big institutions might get priority. It's a very high-risk environment for execution right at the release time.
Okay, so let's wrap this up. It's crystal clear the non-farm payrolls report is massively important. But it's definitely not just one number.
Absolutely not. It's this whole package. You've got the headline job count, you've got the crucial revisions telling you the trend, you've got the unemployment rate from the household survey, but also the broader U6 rate.
The participation rate showing who's in the workforce.
Average weekly hours hinting at labor demand or tightness. And, critically, average hourly earnings, the big inflation signal everyone's watching. It's a mosaic.
And the key takeaway, really, is that you have to look at all of it.
That's the lesson. Don't just react to the headline. Digest the whole thing. See how the actual numbers compare to the consensus across the board. Understand the deviations. And then, most importantly, interpret what that complete picture likely means for the Fed and interest rates.
Because that's what ultimately drives the sustained market moves.
Exactly. Does this report make Fed hikes more or less likely? Does it suggest inflation is heating up or cooling down? Answering those questions based on the full report is how you understand the NFP's real impact.
Right. So considering all this complexity, the multiple data points, the fact they can sometimes send conflicting signals, like strong jobs but weak wages, plus the whole debate around things like the Phillips curve, the employment inflation link, and the sheer chaos this one report causes each month. It does make you wonder, doesn't it?
It makes you wonder what?
Well, how much can one single monthly report, even one this important, truly tell us about the long-term path of the economy or the markets? What might it be missing about the health of workers or the economy?
That's a fair question. It's a snapshot, not the whole movie.
Exactly. And how do we, whether we're traders or just trying to understand the world, balance that intense focus on the short-term volatility it creates with the need for a longer-term view? It's definitely something to think about before the next First Friday rolls around.